Well, we are set to hear from the Bank of Canada on Wednesday about its plans for interest rates, and there is no doubt Canadians struggling with debt payments are hoping for a break. So let's talk more about this. Joining us live in studio is Earl Davis, head of fixed income and money markets at BMO. Earl, good to talk to you about this afternoon, because I think after 8 straight increases to the overnight lending rate, and of course that's translating into mortgage rates, people are kind of going, what's next? Now, the bank has hinted that it's pausing. Do you think that they're going to hold to that on Wednesday?
I think the likelihood is that they do. But there is a small probability that they increase by another 25 basis points. And the reason why I say that is when they said they were pausing, it was a conditional pause, depending on the data that comes out. The data that has come out since that last Bank of Canada announcement has been mixed. We've gotten strong, very strong employment numbers. I'm sure you've spoken about it before, not just last print, but the last 2 prints. But inflation came in lower than expected. That's a good thing. GDP for last year, Q4, came in lower than expected. That's a good thing. The other mixed thing is that the January pre-forecast, basically their forecast, is higher than expected. So I think they paused, but there's a chance that they go higher because the data is not that decisive. And in the U.S., it's even stronger. So one of the great things with the Bank of Canada right now is they're hypersensitive in regards to mortgage rates. It is top of mind. The pain that consumers are having, that is top of mind. But the key thing to remember is if you look at interest rates like a seesaw, on one side is the overnight interest rate, so your variable. On the other side of the seesaw is your 5-year mortgage rate. So the thing is, if they don't raise high enough to stop inflation, the 5-year mortgage goes up. So they're trying to find that perfect balance, and I think they're in a good spot to do so.
You know, if you're sort of sitting around your kitchen table in the evening and sort of taking a look at your finances and you look at this, you know, I don't think many people sort of care specifically about the rest of the economy so much as their own personal balance sheet and things like that here. So what do you think that the Bank of Canada, the pressure they're weighing on that for that whole situation of, like, it's gone up so many straight times. People are, I mean, I know colleagues of mine whose mortgage payment has gone up like $950 a month. A lot of people don't have that money kind of kicking around.
I agree with that. And from a Bank of Canada's perspective, what they're thinking about is if we don't do it now, it could get worse. So they want to ensure that they don't have to raise more next year. And they do that by ensuring that they get inflation now. The other challenge they have is that there's a lag. All the hikes from last year, they haven't kicked in, which is a good thing from us. It means the brunt of the hikes have been done. I believe all of the hikes will be done in 2023. So that it's just, where does that end? And that's the contemplation that they have right now.
I mean, we had a study the other day from one of the big banks, I don't remember which one, saying that, you know, people worry about money for like 15 hours a week, up from like 10 hours the week before. Like, there is just so much of a financial malaise, I think, that's over this Canadian population here. That is this really a key year then, regardless of what happens to the Bank of Canada, to sort of get beyond that?
Yeah, and I think it is. One of the key things, I'm always a person about framing and balance. Yes, we worry about money, but before money, we worry about our jobs. And the good thing is employment is at its lows and going lower. So I think that's a very good thing, that we're getting a paycheck. The next thing now, we have to have confidence that the bank could stop inflation, if not reduce it, so we could start getting lower interest rates.
Right. And I mean, that's kind of like so much of our money in many people's cases is tied up in their homes, right? And tied up in their mortgages. We had a mortgage broker on today who was saying maybe now is the time to buy, but maybe going on the 3-year rather than the 5-year. I mean, it's all depends on your circumstances, et cetera. But I mean, we're all kind of looking at it and wondering, and it's that uncertainty. You know, you're the head of fixed income and money markets. How does financial uncertainty amongst the Canadian general population translate into what you do on a day-to-day basis then?
Well, it translates into the uncertainty. The word we use in financial markets for uncertainty is volatility.
Right.
And volatility is increasing. What's interesting, before in the past, from an investing perspective, it used to be, you know what, you put your money in a passive account, just let it ride. Right now, you have to consider active management. That's what myself and my team does. And why you have to consider active management is because interest rates aren't just going lower, they're going higher, obviously, but they will go lower at some time. And you want to have a manager that's able to capture that and attempt to make money for you in all environments, not just higher interest rate environments, and that's what we do.
All right, well, that's why people pay you the big bucks, I'm sure. Okay, listen, Earl Davis, really appreciate the time. Head of fixed income and money markets from BMO. Thanks for the time and the analysis this afternoon. Do appreciate it.
Perfect. Thank you. I appreciate it as well.